30 minutes, that's all it took. 30 minutes to erase $9 from the price of silver, not 30 days, not 30 hours. 30 minutes. Between 11 o'clock and 11:30 in the morning Eastern Time on Thursday, silver dropped 10.73% and landed at $75.22. Gold fell $163. The Nasdaq was bleeding. The S&P was bleeding, and if you were watching your screen during that window, you saw something that looked less like a market correction and more like someone pulled the plug on the entire financial system at the same time. And here's the part that should bother you. It wasn't about silver, it wasn't about gold, it wasn't about inflation or the Fed or interest rates or any of the things you'd expect to crash precious metals. It started with artificial intelligence stocks, Nvidia, Alphabet, companies that have absolutely nothing to do with a silver bar sitting in a vault, and yet somehow their bad morning became silver's worst 30 minutes since the end of January. And that right there is why I'm making this video, because the headline you're going to read tomorrow morning will say something like, "Silver plunges amid broad sell-off." And that headline will be technically true and completely useless, because it won't tell you how an AI stock decline turned into a precious metals flash crash. It won't tell you what systematic selling means. It won't tell you why algorithms are now the most important force in the silver market. And it definitely won't tell you what this means for the person sitting at home looking at their stack, wondering if they just made a terrible mistake. So I'm going to tell you all of it. The timeline, the mechanics, the players you can't see, and the one question that matters more than the price. I'm Mr. AG Asian Guy, and this is the breakdown nobody else is going to give you. Before we go any further, drop a comment right now and tell me where you're watching from. I ask every time, and every time I'm blown away by the reach. City, country, time zone, whatever you want to share, let me know you're here. And if you haven't subscribed yet, now's the time. Because when markets do this, when they crash in minutes and rewrite the narrative overnight, you want to already be in the room when we break it down. Not scrambling to find someone who'll give you the real version 2 days after it matters. Okay? Let me take you through this minute by minute, because the timeline is everything. And once you see the sequence, you'll understand why this crash has almost nothing to do with precious metals fundamentals, and almost everything to do with a financial system that's wired together like a row of dominoes standing way too close. 9 o'clock in the morning Eastern Time. Markets open, Alphabet starts declining, not crashing, not collapsing, just moving lower. There's weakness in the AI sector. Maybe it's profit taking. Maybe it's a downgrade. Maybe it's just the natural exhale after months of AI euphoria. Whatever the catalyst, the move begins there, in tech, in Silicon Valley's darlings, in the stocks that have been carrying the entire market on their backs for the better part of 2 years. By 10 o'clock, Alphabet has found temporary support. It's stabilized for the moment. But here's the thing about market contagion. It doesn't need the original patient to keep getting sicker. It just needs the fear to spread. And by 10:30, the fear has jumped the fence. The Nasdaq is down 2%. The S&P 500 is down 1.57%. Broad U.S. equities are now in the red, and the selling is accelerating, not because every company in America suddenly became less valuable, but because risk models are flashing yellow and portfolio managers are starting to reduce exposure across the board. And then, 11 o'clock, the metals get hit. And when I say hit, I don't mean a gradual decline. I don't mean a slow drift lower while people assess the situation. I mean a vertical line on the chart pointing straight down. Silver loses $9 in the time it takes to eat lunch. Gold sheds $163. And if you were away from your desk, if you stepped out for coffee, if you were in a meeting, you came back to a completely different market than the one you left. Now here's the question I need you to sit with. Why? Why did silver crash because Nvidia had a bad day? Silver doesn't run on graphics cards. Silver doesn't power large language models. Silver doesn't care about Alphabet's quarterly earnings. And yet silver took a 10% hit because AI stocks sneezed first. The answer is the most important thing I'll say in this entire video, and I need you to really hear it. In a modern, interconnected, algorithm-driven financial system, everything is connected to everything, not because the fundamentals are linked, but because the money is linked. The same pools of capital that are long Nvidia are often the same pools of capital that hold commodity positions. The same risk models that say reduce equity exposure also say reduce commodity exposure. The same algorithms that start selling stocks when volatility spikes start selling metals when the signal crosses a threshold. It's not about silver, it's about risk budgets. And this is where a name comes up that most retail investors have never heard: CTAs. commodity trading advisors. These are systematic, rules-based funds that follow trends and momentum. They don't have opinions about silver. They don't think about supply deficits or solar panel demand. They follow the math. And when the math says momentum has broken, they sell. Mechanically, automatically, without hesitation and without asking whether the selling makes sense from a fundamental perspective. Michael Ball, a macro strategist at Bloomberg, described exactly what happened. He called it algo selling, an air pocket, systematic strategy selling, momentum-driven de-risking from the CTA community when key levels gave way. Read that description again. Air pocket, that's a term from aviation. It means the plane hits a patch of atmosphere where the lift disappears, and for a terrifying moment, you're in free fall, not because the engines failed, not because the wings broke, but because the air that was holding you up simply wasn't there for a second. That's what happened to silver. The air disappeared, the bids vanished, the algorithms pulled back, and for 30 minutes, silver was in free fall without a fundamental reason to be falling. And I need you to understand how that's possible, because this keeps happening, and it will keep happening. And if you don't understand the mechanics, you'll keep getting blindsided. Let me ask you something, and I want the honest answer in the comments. Had you even heard of CTAs before today? Did you know that these systematic funds can move the silver market more in 30 minutes than a year's worth of physical demand? Because most people don't. Most people think the silver price is set by buyers and sellers who actually want silver. And 20 years ago, that was closer to true. But today, in 2026, the marginal price of silver in any given 30-minute window is overwhelmingly determined by participants who will never see, touch, hold, or use a single ounce. That's the reality. And you can either be angry about it or you can understand it well enough to use it to your advantage. Now, there's another layer here that makes this even more absurd. This is the second time in 2 weeks that silver has been massacred like this. The second time. On January 29th, silver lost 26% of its value in a single session. Gold dropped almost $500 that day. And now, barely 2 weeks later, silver drops another 10.73%. Let me put that in perspective. If you had 100 ounces of silver at the January high, you've watched the paper value of that position get cut by more than a third in the space of 14 days. Not because silver became less useful. Not because a massive new mine was discovered. Not because the solar industry invented a silver substitute. Because of leverage, algorithms, and contagion from markets that have nothing to do with the metal. And I'll be honest with you, that pattern, 2 violent crashes in 2 weeks, tells me something. It tells me the market is not in a healthy equilibrium. It's in a state of tension. The paper side is dominated by leveraged, systematic, short-term participants who amplify every move in both directions. And the physical side is constrained by real supply limitations that haven't changed. Those two forces are pulling against each other like a rubber band. And every time the paper side snaps, we get a day like Thursday. And every time the physical side reasserts itself, we get a rebound. And speaking of rebounds, silver did bounce. After the carnage, after the air pocket, there was a recovery. Buyers stepped in at the lows. Some of it was algorithmic, the same systems that sold started covering. Some of it was opportunistic, real buyers who saw the flash crash as a gift. But the bounce was partial, not a full recovery, which means the market is still digesting what happened, and that's where Friday's inflation data becomes critical. The January CPI report is coming out. Consensus expects annual inflation at 2.5%, and depending on what that number shows, we could see the next big move in metals. If inflation comes in hotter than expected, the Fed stays hawkish, rates stay high, and silver faces more headwinds. If inflation comes in cooler, rate cut expectations strengthen, the dollar softens, and silver gets a tailwind. And if it comes in right at expectations, the market will probably continue chopping around while everyone waits for the next signal. But here's what I want you to understand about CPI days. They're not just about the number, they're about positioning into the number. Right now, after 2 violent crashes in 2 weeks, the market is underweight precious metals. A lot of the leveraged longs have been flushed out. A lot of the systematic funds have reduced exposure, which means if the number comes in favorable for metals, there's room for a sharp move higher. Not because anything fundamentally changed overnight, but because the sellers have already sold, the weak hands have already been shaken out. And when you remove the sellers, it doesn't take much buying to move the price. And let me talk about who's been doing the buying during these crashes, because this is the part that doesn't make it into the financial media. While the algorithms were dumping silver futures Thursday morning, there were physical buyers loading up. I know this because every single time we see one of these flash crashes, the same pattern repeats. The paper price plunges. Premiums on physical hold firm or widen. Dealer inventory gets thin, and the people who understand the difference between price and value step up and buy. Think about what that means. The screen says silver is worth $75, but the person standing at a dealer counter is paying $75 plus a premium that hasn't budged, and they're happy to do it because they're not buying a futures contract that expires next month. They're buying a piece of metal that they can hold, store, and keep for years. The futures trader and the physical buyer are looking at the same price and having completely opposite emotional reactions. One is panicking, the other is smiling. And I want to pause here and ask something that I think will generate a really interesting comment section. When you see silver drop 10% in 30 minutes, which person are you? Are you the futures trader watching your account blow up? Are you the physical buyer reaching for your wallet, or are you the person frozen on the sidelines wanting to act but not sure which direction? Tell me. Because there's no wrong answer. But there is a revealing one. Your reaction to volatility tells you exactly what kind of market participant you are, and knowing that is more valuable than any price prediction I could give you. Now let me connect some dots that I think most people are missing. We had a 26% crash on January 29th. We had a 10.73% crash on February 12th. Both times the crash was attributed to forced liquidation, not fundamentals. Both times the selling originated outside the metals market. Both times algorithms and systematic funds were identified as the primary sellers. And both times the physical market responded with strong buying. What's the pattern? The pattern is that silver is being repriced by participants who don't care about silver, and then repriced by participants who do. The algorithms set the low, the physical buyers set the floor, and in between there's chaos that looks terrifying on a screen but barely registers in a vault. And if you're thinking, okay, but what if the algorithms just keep crashing it? What if there's another 10% drop next week? That's a legitimate concern. And the honest answer is, it could happen. Nothing I say can prevent a leverage market from having a leverage event. But here's what I want you to consider. Every crash that's driven by forced liquidation, rather than fundamental deterioration, clears out the speculative excess. It removes the weak positions. It reduces the open interest. It lowers the fuel available for the next forced liquidation. In other words, each crash makes the next crash less likely and less severe. The rubber band can only snap so many times before the tension is released. And here's the part that makes me lean forward. After the January crash, silver recovered. Not fully, not immediately, but it recovered because the fundamental demand didn't go anywhere. And I expect the same pattern here. Because the things that drive silver demand in 2026, solar energy, electric vehicles, AI infrastructure, electronics, medical devices, none of those got a memo from the CTA community saying we're de-risking today. The factories are still running. The panels are still being installed. The EVs are still being assembled. The data centers are still being built. 60% of silver demand is industrial and structural, and that 60% didn't flinch on Thursday morning. So let me give you the framework, because that's what actually survives these events. Not predictions, frameworks. First, separate the paper market from the physical market in your mind. They trade the same commodity, but they operate on completely different logic. The paper market is driven by leverage, algorithms, risk models, and cross-asset contagion. The physical market is driven by supply, demand, and the willingness of real humans to exchange real money for real metal. In the short term, the paper market sets the price. In the long term, the physical market determines the value. And when those two diverge as wildly as they have in the past 2 weeks, history suggests the physical market eventually wins. Second, understand what you're competing against and stop trying to beat it. You are not going to outtrade a CTA algorithm. You don't have the speed, the data, or the infrastructure, and you don't need to. Because you have something they don't: time. An algorithm has a holding period measured in hours or days. You have a holding period measured in years or decades. And in a market with a structural supply deficit, time is the most valuable edge you can have. Every month that passes with demand exceeding supply is a month that tightens the physical market further. The algos don't care about that, but your future self will. Third, use the crashes instead of fearing them. This isn't motivational nonsense. This is math. If you're dollar cost averaging into silver, a 10% crash means your next purchase gets you more ounces for the same dollars. Over time, those extra ounces compound. They lower your average cost. They increase your total position. And when the trend eventually reasserts itself, you're holding more metal than the person who froze every time the chart turned red. Fourth, watch the CPI number tomorrow, but don't let it own you. Whether inflation comes in hot or cold, it's one data point. It will move the market for a day, maybe a week. But it won't change the supply deficit. It won't change the industrial demand trajectory. It won't change the fact that 70% of silver production is a byproduct of other mining and can't scale on its own. Those are the things that matter over quarters and years. The CPI number matters over hours and days. Know the difference. And fifth, this is the one I want you to screenshot. Stop watching the price and start watching the behavior. When silver crashes and dealers run out of inventory, that's a signal. When silver crashes and premiums hold firm, that's a signal. When silver crashes and first-time buyers walk into coin shops asking how to get started, that's a signal. The price tells you what happened. The behavior tells you what's coming. And right now, the behavior is telling you that physical demand is alive and well despite, or maybe because of, the paper market chaos. Now I want to address something that I see in the comments every time I make one of these videos. Someone always says, if the paper market is fake, why do we even look at it? And I understand the frustration. But the paper market isn't fake. It's real. It has real consequences. It determines the price at which miners sell their production, the price at which industrial users buy their input, and the price at which your local dealer calculates premiums. You can't ignore it. What you can do is understand its limitations. The paper market is excellent at discovering short-term price. It's terrible at reflecting long-term value in a physically constrained market. And silver in 2026 is a physically constrained market, full stop. So when the paper market gives you a flash crash driven by AI stocks and CTA algorithms and cross-asset contagion, you have two choices. You can take the paper market's word for it and assume silver is suddenly worth 10% less than it was at breakfast. Or you can look at the supply deficit, the industrial demand growth, the physical buying patterns, and the structural constraints on mine supply, and ask yourself whether a 30-minute algorithm-driven sell-off changes any of that. And if it doesn't, then the crash isn't a verdict. It's a discount. I want to hear from you on two things before I wrap this up. First, how many of these flash crashes have you now lived through? Is this your first? Your second? Your 10th? I want to know because your experience level changes how these events feel. The first one is terrifying, the fifth one is annoying, the 10th one is just Tuesday. Tell me where you are on that spectrum. And second, if you could ask one question to a market maker who was active during Thursday's crash, what would you ask? Drop it in the comments. I read every single one, and the answers help me shape future videos. If you made it this far, you're the reason this channel exists. You don't want the easy answer. You want the real one. Even when the real one is complicated and uncomfortable and doesn't fit neatly into a headline, that's what we do here at Mr. AG Asian Guy. We go deeper than the surface because the surface is where people lose money. Subscribe if you haven't. Share this with someone who saw the crash and doesn't understand what happened. And come back tomorrow because depending on what the CPI number shows, we might have a lot to talk about. And as always, mandatory disclaimer, everything in this video is for education and discussion. I am not a financial advisor. I am not telling you to buy, sell, or hold anything. This is not financial advice. Your money, your decisions, your risk. Size your positions responsibly. Don't invest what you can't afford to lose. Volatility is the price of admission in this market, and the toll booth doesn't accept excuses. Make your own plan and stick to it. I'll see you in the next one.